The United Arab Emirates leaving OPEC after 6 decades is not just an oil story. It is not just a Middle East story. It is not just a story about production quotas, regional alliances, or whether one country wants to pump more barrels than another. Those things matter, but they are not the deepest part of the story. The deeper part is the dollar. More precisely, it is the system that helped make the dollar the center of the world after the dollar was no longer backed by gold. For most people, this sounds abstract. They think the value of a dollar is obvious. They hold a $100 bill and say it is worth $100. But that answer hides the real question. What is $100? It is a number printed on paper or recorded digitally in a bank account. What matters is not the number itself. What matters is what that number can buy. $100 today does not buy what $100 bought 5 years ago. It certainly does not buy what $100 bought 50 years ago. That is not just inflation in a narrow sense. It is a window into the changing nature of money. Money is not fixed. Money is a system of trust. And when the trust system changes, wealth moves. That is the point most people miss. They think currency is stable because the number printed on it does not change. But the value is not in the printing. The value is in the trust behind it, the demand for it, the government that issues it, the assets that support it, the military and financial system behind it, and the willingness of others to accept it in exchange for real goods. If trust weakens, the paper can still say $100 while the purchasing power quietly falls. That is how monetary transitions usually begin. Not with a loud announcement, with purchasing power slipping, with reserves shifting, with trade settlement changing, with central banks buying different assets, with oil producers accepting different currencies, with countries asking whether the old system still serves them. That is why the UAE's move matters. It is not because the dollar collapses tomorrow. It is because the system that created constant demand for dollars is being questioned at the margin. And marginal changes matter. In markets, prices are set at the margin. In geopolitics, power often shifts at the margin before the headline admits it. In monetary systems, trust erodes slowly before it becomes obvious. To understand this, you have to go back to 1971. Before 1971, the dollar was connected to gold under the old Bretton Woods system. The dollar was not just a floating piece of paper. It had convertibility into gold for foreign governments under that system. Gold provided discipline. It limited how far the government could go because the promise connected dollars to a finite asset. You cannot print gold. That was the constraint. If the government wanted to spend far more than it had, the gold link created pressure. If too many dollars were created relative to the gold backing, confidence would eventually break. Foreign holders could ask for gold, the system would be tested. Then on the 15th of August, 1971, President Nixon suspended the convertibility of dollars into gold. It was called temporary. But many temporary policies in history become permanent arrangements when the incentives are powerful enough. Once the dollar was no longer convertible into gold, the world moved into a different monetary era. The dollar became fiat currency. Fiat means it is not backed by a physical commodity like gold. It is backed by confidence, by government authority, by tax power, by military power, by financial depth, by legal institutions, and by the network effect of everyone else using it. That can be very powerful. But it is also more psychological. A fiat currency lives on trust. Trust that the issuing government will not destroy the purchasing power too quickly. Trust that the financial system will remain open and liquid. Trust that the rule of law will protect capital. Trust that other people will continue accepting the currency. Trust that reserves held in that currency will remain usable. Trust is not a small thing. It is the foundation of the whole system after the gold link was broken. The United States needed another source of structural demand for dollars. That source became oil. In the 1970s, the United States made a strategic arrangement with Saudi Arabia. Saudi Arabia would price and sell oil in dollars and recycle oil profits back into dollar assets, especially U.S. treasuries. In return, the United States would provide weapons, security, and military protection. This became the foundation of the petrodollar system. It did not mean every barrel of oil in the world was governed by a single clean legal agreement. Systems are rarely that simple. It meant that the world's most important commodity became deeply tied to the dollar. Every country needs energy. Every country needs oil in some form, directly or indirectly. If oil is priced in dollars, then countries need dollars to buy oil. That creates demand. A country that does not trade much with the United States may still need dollars because it needs oil. A country that does not like American policy may still need dollars because the oil system runs through dollars. A central bank may still hold dollars because dollars are needed for trade, reserves, debt servicing, and energy settlement. This is the power of a network. The dollar did not need gold in the same way anymore because it had oil and treasury markets and global settlement behind it. Oil demand created dollar demand created treasury demand. Treasury demand helped the United States borrow at lower rates than it otherwise could. Lower borrowing costs allowed the United States to run larger deficits. Those deficits supported American consumption, military reach, and global financial influence. That is the machine. Most people lived inside the machine without seeing it. They earned dollars, spent dollars, saved dollars, invested in dollar assets, and assumed the dollar was naturally at the center of the world. But the dollar's position was not natural. It was built. And what is built can be weakened if the incentives change. For decades, the arrangement worked well for the United States. The world needed dollars. Oil exporters accumulated dollars. Those dollars flowed back into U.S. financial markets. Treasury demand stayed strong. The United States could import real goods and export financial claims. It could borrow in its own currency. It could run deficits that would destroy many other countries. That was America's exorbitant privilege. But every privilege creates dependence. America became dependent on the world continuing to believe in the dollar, continuing to hold treasuries, and continuing to settle critical trade in dollars. The world became dependent on a U.S.-centered financial system. That system worked when trust was high, but trust began to change. The pandemic accelerated the change in 2020. The United States government spent an enormous amount of money. Stimulus checks, unemployment benefits, PPP loans, business support, emergency programs, bailouts, liquidity facilities, and central bank intervention all flooded the system with dollars. Some of this was understandable. The economy was facing an emergency. Businesses were shut, households were under pressure, financial markets were breaking. Policymakers chose to prevent collapse, but the consequence was clear. More dollars were created, and when more dollars are created without a matching increase in real wealth, the value of each dollar is pressured. You can print more currency, you cannot print more real wealth, you cannot print more oil, you cannot print more land, you cannot print more productive capacity instantly. You cannot print trust indefinitely. That is the problem with fiat money. It can be expanded quickly during crisis, but every expansion asks the world to keep believing that future purchasing power will be protected. After the pandemic, countries around the world looked at the United States and saw the money printer running. They saw the government spend money it did not have. They saw the Federal Reserve expand its balance sheet. They saw inflation follow. They saw the dollar's purchasing power fall for ordinary people. And they began asking a rational question. Do we want our reserves, our trade, and our economic security tied so heavily to a currency that can be printed in such quantity? That question did not destroy the dollar, but it changed the conversation. Then Russia invaded Ukraine, and the United States and its allies responded with sanctions, including freezing or immobilizing significant Russian reserve assets held in Western financial systems. Many people in the West saw this as a justified response to aggression. But central banks around the world saw another lesson too. They saw that reserves held in another country's financial system are not purely neutral assets. They can be frozen, they can be weaponized, they can be turned into geopolitical leverage. Again, this does not mean every country suddenly abandons the dollar. The dollar system is too large, too liquid, and too deeply embedded for that. But reserve managers are paid to think about risk. After the Russia sanctions, the risk model changed. If the United States can freeze Russia's assets, then any country outside the U.S. alliance system has to ask whether its assets could be frozen someday too. Even countries not hostile to the United States may want more optionality. That is why many central banks began increasing gold reserves. Gold has no counterparty risk when held directly. A treasury bond is someone else's liability. A bank deposit is someone else's liability. A dollar reserve inside a Western institution is exposed to Western legal and political decisions. Gold in your own vault is not a promise from another government. It is an asset. That is why gold became more attractive. Not because gold suddenly became modern, because the world became more uncertain. The next piece is the decline in the dollar's share of global reserves. In 2001, around 72% of global foreign exchange reserves were held in U.S. dollars. By the end of 2025, that figure had fallen to around 56% in the framework of the source. That is still dominant. 56% is not collapse. It is still the largest share, but the direction matters. The dollar does not need to go from 56% to zero for this to matter. If reserve share falls from 72 to 56, that already represents a significant shift in how the world thinks about dollar concentration. The world is diversifying slowly, unevenly. But clearly, this is how large systems change. They do not always collapse, they become less absolute. And the difference between an absolute monopoly and a strong but declining dominance can be enormous for markets, interest rates, inflation, gold, oil, and asset allocation. Now bring China into the picture. China has been growing as an economic power. It wants its currency to play a larger role in global trade. It does not want the world's most important commodities to be permanently settled only in dollars. It also does not want to remain structurally dependent on a financial system controlled by its biggest geopolitical competitor. That is why China created oil futures priced in yuan. That is why China has pushed for more trade settlement in its own currency. That is why it has built relationships with oil producers. That is why it has worked with Saudi Arabia, Russia, Iran, and other countries in ways that reduce dependence on the dollar. In 2023, Saudi Arabia began selling oil to China in yuan under the framework described by the source. This mattered, not because all Saudi oil instantly moved away from dollars, but because Saudi Arabia was the very country that helped build the petrodollar system with the United States. When the builder of the system begins experimenting outside the system, pay attention. Again, do not exaggerate. The dollar remains deeply used, but the symbolic and structural meaning is important. If the country that helped make the petrodollar starts accepting yuan from China, then the monopoly has been cracked. A crack is not collapse, but cracks tell you where pressure is building. Now the UAE enters the story. The UAE has been more vocal about de-dollarization and has worked with countries like India to settle trade in local currencies. It has wanted more independence. It has wanted more flexibility. It has wanted to make decisions on its own terms rather than simply follow an old oil order. Leaving OPEC after 60 years is therefore not only about oil quotas, it is about sovereignty. It is about whether an oil producer wants to be constrained by a group whose historical structure was tied to the old petrodollar world. It is about whether Gulf states want to diversify relationships among the United States, China, India, and other powers. It is about whether oil revenue will continue to flow automatically into dollars and treasuries or whether a more fragmented system is emerging. That is why investors should care. The UAE may not announce tomorrow that it will never use dollars again. That is not the point. The point is that oil producers want optionality. They want to sell to China. They want to sell to India. They want local currency settlement when it suits them. They want to hold gold. They want to avoid being locked into one geopolitical system. They want bargaining power when sellers of the world, as most important commodity, want more optionality. The old monetary structure weakens. This affects the United States because Americans earn, save, borrow, and invest in dollars. If the dollar's global demand weakens at the margin, the United States may face higher pressure over time. It may face higher borrowing costs. It may face more inflationary pressure. It may face greater difficulty financing deficits. It may face more pressure to protect the dollar's credibility. It may face more volatility in asset prices, and ordinary people may feel it not through a headline, but through their wallet. A weaker dollar can make imports more expensive. Higher oil prices can raise gasoline and food costs. Higher borrowing costs can affect mortgages, credit cards, auto loans, and business loans. Lower foreign demand for treasuries can affect interest rates. A higher inflation environment can reduce the real value of wages and savings. This is how macro becomes personal. Most people do not need to trade currencies to be affected by currency shifts. They feel it in the cost of living. Now, what should an investor do? The first potential response is gold, but gold must be understood correctly. I do not think of gold as a business investment in the same way I think of a stock. A productive business can generate earnings, reinvest capital, innovate, hire people, expand margins, and compound value over time. Gold does not do that. Gold sits there. It does not pay dividends. It does not grow earnings. It does not create a product. It is not a business. But that does not mean it has no role. Gold is a monetary hedge. It is a way to hold something outside the fiat currency system. It is a way to protect against the risk that governments create too much currency, that debt burdens become too large, that central banks debase purchasing power, and that geopolitical trust weakens. Gold often rises when confidence in the dollar weakens. After 2008, gold rose because the government and central bank responded to crisis with money creation and emergency support. Then, when the economy stabilized and fears about the dollar declined, gold fell and stayed weak for years. After the pandemic, the money printer turned on again, inflation rose, and concerns about the dollar returned. Gold began rising again. More recently, central banks have been major buyers of gold. Countries like China, Turkey, and others have been increasing gold reserves as a way to strengthen balance sheets and reduce dependence on the dollar system. This is important. Gold is not rising only because retail investors are afraid. It is rising because institutions responsible for national reserve management are diversifying. That is a stronger signal. But gold is not risk-free. Gold prices can fall. If fear about the dollar declines, gold can decline. If real interest rates rise, gold can struggle. If investors become too crowded in the trade, pullbacks can be sharp. So gold should be sized as a hedge, not treated as a magic answer. Some people prefer physical gold. Physical gold gives direct ownership but requires storage, insurance, security, and careful buying and selling. Others prefer gold ETFs like GLD or other similar funds, which provide easier market exposure but reintroduce dependence on the financial system. Both choices have trade-offs. The principle is not that everyone must buy gold. The principle is that investors should understand why gold becomes more relevant when confidence in fiat currency and dollar monopoly weakens. The second response is international diversification. If the dollar's dominance is slowly weakening, investors may want some exposure outside the United States. This does not mean abandon America. The United States remains one of the greatest opportunity engines in the world. It has deep capital markets, innovative companies, strong institutions relative to most places, military power, technological leadership, and enormous entrepreneurial capacity. But even a great country should not be your only exposure if the world is becoming more multipolar. International investing gives diversification. It can provide exposure to economies growing under different conditions, currencies that may strengthen relative to the dollar, and markets that may benefit if capital flows away from the United States. There are broad international funds that hold many countries outside the United States. There are developed market funds for larger established countries. There are emerging market funds for faster growing but riskier economies. There are country-specific funds for investors who want targeted exposure to China, India, Germany, or other markets. Each has different risks. International investing is not automatically safer. Foreign markets can have political risk, currency risk, weaker legal protections, lower transparency, accounting differences, liquidity issues, and geopolitical exposure. Emerging markets can be especially volatile. But diversification is about not relying on one outcome. If all your wealth is tied to the US dollar, the US stock market, US policy, and US debt, then you are concentrated in one system. That system may still do very well. But concentration is still concentration. A thoughtful investor asks how much US exposure is appropriate and how much global exposure improves resilience. The third response is energy. If the petrodollar system is under pressure, if oil producers want more independence, if geopolitical conflict affects supply routes, and if the United States needs to become more energy independent, domestic energy companies may benefit. Energy is not only a commodity trade, it is a national security issue. Oil affects inflation, oil affects trade balances, oil affects military strategy, oil affects manufacturing, oil affects transportation, oil affects the cost of everything. If the old global oil settlement system is changing, and if the United States wants less dependence on foreign energy systems, then investment may flow into domestic production, refining, pipelines, storage, LNG services, and energy infrastructure. A broad energy ETF like XLE gives exposure to large U.S. energy companies such as ExxonMobil, Chevron, and ConocoPhillips. These companies are not pure oil price bets, but their profitability is tied to energy markets, capital discipline, reserves, production, refining, and shareholder returns. Energy can perform well during inflationary or geopolitical stress periods because energy prices often rise when supply is constrained. But energy is cyclical. Oil prices can fall hard. Energy stocks can underperform for years. Policy can change. Demand can weaken in recession. So energy exposure should be understood as part of a diversified portfolio, not a guaranteed hedge. The fourth response is defense. When geopolitical tensions rise, governments spend more on military equipment, aerospace, missiles, naval systems, aircraft, cyber capabilities, intelligence, drones, satellites, and logistics. Whether someone likes that morally is a separate question. As an investor, you have to understand how capital flows. When the world becomes more dangerous, defense budgets often rise. Defense companies can benefit from long-term government contracts, aerospace, and defense ETFs, such as ETF or similar funds, provide exposure to companies that may benefit when governments increase military spending. There is an ethical dimension. Some investors are comfortable owning defense companies because they believe national security is necessary. Others do not want to profit from weapons or war-related spending. That is a personal decision. A good portfolio must fit not only your financial goals but also your principles. But from a market perspective, defense is one of the sectors that can benefit from geopolitical fragmentation. The fifth response is still investing in the United States. This may sound contradictory after discussing dollar risk. It is not. The dollar system may be under pressure, and the United States may still remain the greatest source of opportunity. Both can be true. Too many people think in extremes. The dollar is doomed, so sell everything American, or America is invincible. So ignore every warning. Both are simplistic. The United States economy is not going to collapse tomorrow simply because the UAE leaves OPEC. The dollar is not going to zero tomorrow because China settles some oil in yuan. The S&P 500 is not suddenly worthless because global reserves are shifting. The United States still has extraordinary companies. The S&P 500 gives exposure to many of the world's most powerful businesses. American technology, healthcare, finance, energy, defense, consumer brands, and industrial companies still matter globally. Long-term investors should not panic sell productive assets because of one monetary shift. The right answer is balance. Gold as a hedge, international exposure as diversification, energy as an inflation and geopolitical exposure, defense as a geopolitical spending exposure if it fits your values. U.S. equities as productive ownership in one of the world's strongest economies. This is how a portfolio adapts without panicking. Now, let us return to the $100 bill because that is where the lesson began. The number on the bill does not change. The purchasing power changes. If the petrodollar system weakens, the long-term demand for dollars may weaken. If the U.S. government continues printing and borrowing, the supply of dollars and dollar claims grows. If other countries diversify reserves, the support underneath the dollar becomes less automatic. More supply and less automatic demand is not good for purchasing power. That is the simple economic logic. This does not mean catastrophe, it means risk. Risk should not paralyze you. Risk should make you prepare. The average person hears about de-dollarization and either ignores it or panics. Both responses are wrong. Ignoring it means missing a slow structural change. Panicking means making emotional decisions that can destroy wealth. The right response is to think like an investor. What is the trend? What are the incentives? Who benefits? What assets hedge the risk? What assets still produce value? How do I diversify without abandoning long-term compounding? That is the framework. The trend is that some countries are looking for alternatives to the dollar. The incentives are reserve safety, geopolitical independence, and economic bargaining power. The beneficiaries may include gold, certain international markets, energy, defense, and productive assets with pricing power. The risk is that the dollar remains dominant longer than expected and some hedges underperform. The portfolio answer is not one bet, it is diversification. Now let us talk about belief. A fiat currency has value because people believe it has value. But belief is not mystical. It is tied to structure. People believe in the dollar because the United States has taxing power, military power, deep capital markets, legal systems, liquidity, technology, and the world's most important treasury market. Those are real strengths. But belief can weaken if debt grows too large, if inflation remains too high, if reserve assets can be frozen, if political conflict worsens, and if alternative trading systems become good enough. The dollar is not backed by gold, it is backed by confidence. Confidence must be maintained when the United States prints too much, borrows too much, sanctions too broadly, and runs persistent deficits. It spends confidence. That does not mean the confidence runs out tomorrow, but confidence is not infinite. The petrodollar helped restore and maintain confidence after gold convertibility ended. It gave the dollar a structural use case that was necessary for every country. If that use case becomes less exclusive, the dollar must rely more heavily on other strengths. Again, not collapse repricing. That is the mature interpretation. Now we should also think about what countries want. China wants more influence for the yuan, but many countries may not want to replace dollar dependence with yuan dependence. The yuan is not freely convertible in the same way. China has capital controls. Its legal system is different. Its financial markets are not as open or deep as U.S. markets, so the future may not be one currency replacing another. It may be fragmentation, more bilateral settlement, more regional currencies, more yuan for China trade, more rupees for India trade, more gold and central bank reserves, more local currency arrangements, more commodity-backed settlement discussions, more payment systems outside Western control. The dollar still dominates, but the system becomes more multipolar. That kind of world is more complex. Investors must become more diversified. Now let us discuss what not to do. Do not assume every gold rally continues forever. Gold can fall hard when dollar fears fade. Do not assume international markets automatically outperform. They can underperform the United States for long periods. Do not assume energy stocks are safe. They are cyclical and can fall with oil prices. Do not assume defense stocks are immune. Budgets, politics, contracts, and valuations matter. Do not assume U.S. stocks are finished. Many of the world's best companies are still American. Do not build a portfolio based only on fear. Fear can get you into hedges too late and out of productive assets too early. The goal is not to make a fear portfolio. The goal is to make a resilient portfolio. A resilient portfolio does not need one exact future to happen. It can handle multiple outcomes. If the dollar remains strong, U.S. equities and dollar assets can still work. If the dollar weakens, gold and international exposure can help. If oil conflict rises, energy and defense may help. If innovation continues, U.S. technology and broad market exposure can help. If inflation persists, real assets and companies with pricing power can help. That is the point. Diversification is humility expressed in asset allocation. Now, there is one more practical issue. Many people watch monetary shifts and then try to trade headlines. They buy gold after a big spike. They sell stocks after a scary article. They buy international markets because of one de-dollarization story. They chase oil after a war headline. That is not investing, that is reacting. A long-term investor uses these changes to build a framework and then allocates gradually dollar-cost average rebalance. Keep cash reserves. Avoid overconcentration. Understand what each asset is supposed to do. Gold is a hedge. Stocks are productive ownership. Energy is a cyclical inflation and geopolitical exposure. Defense is a geopolitical spending exposure. International funds are geographic and currency diversification. Cash is liquidity. Each asset has a role. Do not ask one asset to do every job. That is how people make mistakes. Now, let us bring this back to the UAE. The UAE leaving OPEC may or may not produce immediate market chaos. The immediate effect may be debated. Oil prices may move one way and then another. Analysts may argue about production, quotas, and regional politics. But the deeper direction is more important. A country that has been connected to the oil dollar order wants more independence. It has been willing to work with local currency settlement. It is part of a broader pattern of de-dollarization pressure. It is one more signal that the old system is not as automatic as it used to be in investing. One signal is not enough, but repeated signals matter. Saudi Arabia exploring yuan settlement. China creating yuan oil futures. India doing more local currency energy trade. Russia forced outside the dollar system, central banks buying gold. The dollar reserve share declining, the UAE stepping away from OPEC together. These signals tell a coherent story. The dollar remains central, but the world is building alternatives. That is the story. Now, what does this mean for the ordinary American? It means you should not assume that saving dollars alone is a complete wealth strategy. You need ownership. Ownership of productive assets, maybe ownership of some hard assets, maybe exposure to international growth, maybe energy exposure, maybe defense exposure if it fits your values. You need assets that can adapt if the dollar's purchasing power declines. Working for dollars and saving dollars in cash may not be enough if the real value of those dollars keeps falling. This is the basic lesson of inflation. If wages do not rise faster than prices, workers lose. If savings do not earn more than inflation, savers lose. If assets rise with inflation, owners can be protected. That is why asset ownership matters. This is not greed, it is protection. Now, many people will say, I am not an investor, but in a fiat currency system, not investing is also a choice. Holding cash is a bet on the currency. Holding no assets is a bet that wages and savings will protect you. Holding only US dollar assets is a bet on continued US dominance without meaningful debasement. Maybe those bets work for a while, maybe they do not. The point is to know that they are bets. There is no neutral position. Even doing nothing is a position. That is why financial education matters. A person who understands money can adapt. A person who does not understand money only feels the consequences later. The petrodollar system allowed Americans to live with a stronger dollar than they might otherwise have had. It allowed cheaper imports. It supported lower borrowing costs. It made deficits easier to finance. If that system weakens, the adjustment may show up slowly. Higher prices, more inflation, more volatility, more pressure on debt, more geopolitical tension, more importance for hard assets, more need for diversification. This does not mean fear. It means awareness. Now, let us be balanced about the United States. America still has immense strengths. The deepest capital markets, the most important technology companies, a powerful military, a culture of entrepreneurship, the reserve currency, a huge consumer market, legal and financial infrastructure, energy resources, world-class universities, innovation capacity. These strengths do not disappear because the UAE leaves OPEC. So do not become a doom investor. Doom investors often miss the compounding power of great businesses. They spend decades waiting for collapse while productive assets rise, but do not become complacent either. Complacent investors ignore structural shifts until purchasing power is already lost. The right posture is neither doom nor complacency. It is disciplined adaptation. Keep productive assets, add hedges, diversify geographically, understand energy, respect defense, and geopolitical cycles. Think in purchasing power, watch reserve behavior, watch oil settlement, watch debt and deficits, watch central bank gold buying. That is how you think like an investor. Now, one of the most important ideas is that the best opportunities often come from things people do not pay attention to. Most people paid no attention to the petrodollar system while it supported the dollar for decades. They did not need to understand it when the system was working, but when the system starts changing, not understanding it becomes expensive. The things that matter most are often invisible until they break. Plumbing is invisible until the house floods. The grid is invisible until the lights go out. The monetary system is invisible until prices rise and trust weakens. That is why investors study systems before they break. If you wait until everyone agrees that the dollar system has changed, the asset prices will already reflect much of that change. Gold may already be higher. International markets may already be repriced. Energy may already have moved. Defense stocks may already be expensive. Interest rates may already have adjusted. The work must be done before the crowd understands the story. Now, let us summarize the entire mechanism. Before 1971, the dollar was connected to gold. After 1971, the dollar became fiat. In 1974, the petrodollar arrangement helped create global demand for dollars by tying oil trade to the dollar and recycling oil profits into treasuries. For decades, this supported U.S. financial power after the pandemic. Massive money creation raised doubts about the dollar's long-term purchasing power. After Russia's reserves were frozen, countries realized dollar reserves could be politically vulnerable. China pushed yuan oil settlement and created yuan-priced oil futures. Saudi Arabia began accepting yuan in some oil trade. The UAE, already interested in de-dollarization and local currency settlement, is leaving OPEC. Global dollar reserves have declined from roughly 72% in 2001 to about 56% by the end of 2025 in the source framework. Central banks have been buying gold. The dollar remains dominant, but the monopoly is weakening. That is the chain. And the investment response is not panic. It is thoughtful diversification, gold for monetary hedging, international exposure for geographic and currency diversification, energy for oil and inflation, related exposure defense for geopolitical spending exposure, U.S. equities for continued participation in American productivity and innovation, cash for flexibility, and above all, a long-term investor's mindset. Do not panic sell when markets go down. Do not chase only when markets hit all-time highs. Do not blindly trust a random person with your money. Do your own work. Understand the risks, invest with time, discipline, and a system. Because if this monetary transition continues, it will not reward the people who are only emotional. It will reward the people who understand the machine. The value of a dollar is not guaranteed by the ink on the paper. It is supported by trust, demand, and power. The petrodollar was one of the great pillars of that demand. If that pillar weakens, the world does not end tomorrow, but the rules of the game begin to change. And when the rules change, the prepared investor adjusts before the unprepared person feels it in the cost of living. That is the lesson. The UAE leaving OPEC is the headline. The dollar losing automatic demand is the story. Gold, energy, international markets, defense, and productive assets are the places investors should think carefully about. Not because anyone can know the future, because the system is sending signals. And when the system sends signals, the worst thing you can do is ignore them until they show up in your wallet.